Most traders mark valid key levels but still lose, not because the levels are wrong, but because they ignore the behavior happening around them. In this video, I'll show you how to validate your key levels and take sniper confirmation entries using the concept of price behavior analysis. This is part of the high probability trading series. Make sure to watch all of the episodes to build your A+ trades. Let's start. Confluence 5 Price Behavior Analysis. Now, we already in the previous lectures of this series, we've talked about price position, about ranges, about structure and valid structure, and about candle open and buys. So all of these 4 things here all help us with identifying key levels. But today we're going to be looking inside of the key level, not identifying but validating the key level. Now, price behavior goes into 2 different aspects: the price behavior of approaching the key level and price behavior inside the key level. So 2 different things, and we're going to cover these. Now, the first one is telling me even before price goes into the key level, it's approaching the key level. It tells me if it's valid or not, and if I should use it or not. And then inside the key level, and that is the trigger. So talking about approaching the key level, we have 2 main approaches here. And these are the 2 that you want to focus on and avoid everything else. And in the examples, you're going to notice how only if you apply this, it's going to make a big difference in your trading style and your setups, okay? You're going to be focusing more on valid key levels other than levels that are even just looking at the approach of them, they're going to be failing, okay? So the first one is the impulsive approach. That means, and a lot of people mistake this, they think that if they have a key level and prices come in aggressively to their key level, it's going to not hold, okay? And it's going to fail. The reality is, though, the more impulsive it's coming to your key level, the better it is, at least for me. And why? Because fast, aggressive move, it often signals exhaustion at the level. So if it's coming very strong into your key level, at this point, because it moved aggressively for some time, it can find exhaustion at your key level. And that is what you want, okay? And for this one, for the impulsive approach, it's gonna end up and it's gonna have a sharp reversal possible. And this is what I do, and it's cool. Actually, a lot of time, if you're catching a reversal, I want to see price coming up aggressively because it's gonna go down aggressively. And that is why impulsive approach is making a big difference in my trading style. Now, I do validate key levels by how impulsive prices come into them and approaching them. Now, we do have another tab, which is the corrective approach. It could be as a channel, as a trend line, as a flag, okay? That is a clean retracement. It's, for me, a higher probability that the level will be respected, but in another way. So it's not going to be same as the impulsive or price reverse aggressively. Now, really, it's going to be in a different way, and I'm going to teach you this in the examples. So these are the 2 only approaches that you want to focus on. The other approaches do not matter. You need to keep it simple. I want you to focus on these. There are a lot of different ways that price could approach your key level, but this is what I want you to focus on because they're going to give you the best results. Before we continue, I've taken everything I've learned over the past 7 years and put it into one place. It's cool. Inside, you will get the full blueprint to finally make it in trading, including the exact strategy I use every day, the edge model. These are some of the trades I've taken with my members. You are welcome to join if you are ready to make the real change in your trading. Let's continue. So let's look at some examples regarding the approaches into the key level, the types of approaches. Now, one thing I want you to see, now I'm zooming out in the chart, and this is euro dollar on the 4-hour time frame. I want you to notice every time price goes aggressively somewhere, it's going to reverse aggressively. So if I can notice here how price was going down aggressively, at some point, look at the reaction, even though it slowed down here, but then into the main key level and then pushing up aggressively. So when price goes to a key level aggressively, it's going to come out of it most of the time if the key level is valid, or based on probability, you're thinking of price coming out of that key level also aggressively. That's one of the approaches. And I always love to take trades like this. And why? Because whenever I take an entry, price is going to go up aggressively. First of all, giving me high reward to risk. And then price is most of the time not going to come back to my entry. So if you notice, if you enter here after this strong push to the downside, impulsive move, price going up here, you enter somewhere in here based on the edge model, based on any type of entry you have, and then look at what happened after. Price never come back to this entry here. Price just keep going higher after, and then even if you go break even, you're safe. But a lot of other times, if we notice, whenever price, if we have a key level here, okay, whenever price comes down to that key level, and whenever it goes close to it, it's slowing down and the structure is becoming way too weak, and then you have a lot of noise. This noise here, or this small structure, what's gonna happen is gonna continue here, and then until we cannot go long now until we see some strength happening, because whenever we have price coming down aggressively, it means that at some point it's gonna have, or it's gonna get exhausted, because now it's coming down in a very aggressive way. At some point it's not gonna be able to continue, so we might have a quick reversal. It's gonna have exhaustion here and then strength. But in this case, there is nothing happening in the beginning. Price is just slowly coming lower. That means a lot of times in this situation, what I wait for is, not enter based on the key level that I have, and then wait for a strong move either to the upside or downside. So this could happen downside and I'm gonna enter here. And another scenario that could happen is finding strength from here, and then I can look for the continuation. But when we have this type of price behavior approaching the key level, this is something that I don't want to see. Now there is the other tab, which is the corrective one, where price have a structure and the structure is big enough, and then it's doing something like this. This could still work, and you want to focus on the last leg of price action coming into that key level. You want it to be a strong move. You don't want to see a very weak move, and after that we can also look for long entries here. Now we're gonna also cover the internal one, or the price behavior inside the key level. Now take a look at this. As price, for example, I do have, for this structure, we're going up, okay, and I do have a key level here, and notice what happened. As price is going up, coming lower, going up, notice how strong this move was. Very impulsive move. After an impulsive move, price is overextended here to the downside. Based on the structure we have, this move is very strong to the downside. Expect the same to happen on the upside. Now based on the key level here that we have, taken an entry, and I think we have executed this one together, not sure, but this is a pure edge model. You enter here, going up, and look at how price moving aggressively instead of other times where price is ranging, when price is just way too weak here, there's no impulsive moves. But notice when price moves aggressively, it's a lot of time over exhaustion there, and it's gonna reverse also aggressively. Now a type of the corrective move, I think we have, notice this one here. Even though price was going lower slowly, and if you notice, it's in a type of corrective move. So if we take a trend line here, it's gonna show as a trend line. So price has been, or also a channel here. And if you notice, as price is going lower in a channel type, when price reach the key level, you can look for longs. Now here it's a bit tricky. I'm not gonna say I've entered here, it's a bit tricky, yeah. Then after that, if you notice, price move up. So this is a corrective move. This is also another corrective move, but this one is a bit more impulsive. So this one is still a corrective move, more impulsive. And when price reach a key level, you can still look for shorts. And if you notice, again, same thing. So you don't want to see price approaching your key level in a ranging way. You either want it to be in structure, so it's coming down in a structure like a channel or trend line or a flag, or you want it to be very impulsive. So price is going down without any retracement, without nothing. Know that at your key level, if price is already overextended, it might just push up the same way it was coming down. So yeah, for example, if we notice, if we go back here, yes, it's coming down in a channel way. If you notice here, into your key level. Now in this case, it was taking this low into an imbalance and then going higher. And if you notice, after taking that low, there was nothing here except price pushing higher. Yes, another retracement, and then pushing higher. And also here, whenever we have strong move like this, no matter what, if we have a key level and even if it's against the trend, because we had an impulsive, there needs, sometime we're going to have exhaustion somewhere, and you can even take entries here to the downside. So in simple terms, what I want to see at my key level when price is approaching, I want to see either a big structure coming up to my key level, or I want to see an impulsive move, which is going to give me another impulsive move on the other side. I don't want to see, as prices come into my key level, slowing down and a lot of ranging here. Whenever we have this, we need more confirmation to enter, because this thing here is going to tell me that we either have a break to the downside, which you need a confirmation for, or what could happen is a break to the upside, which if you entered earlier is going to result in a loss. So now let's talk about the price behavior analysis, but now inside the key level and not just approaching the key level, but what happened inside the key level itself. Now think about, price approaching the level is validating the level, means that before even price reaching the key level, I'm validating if the level is good to use or not. However, the inside price behavior, so when price goes into the key level, that is, think about it as the trigger, telling you when to take the entry, and that is the difference. So here we have three main triggers to focus on. Now, some people would have some other key triggers. These are mine, and these are the ones that I prefer to see inside of a key level. So this is our key level here. What I want to see inside is 1, 2, or 3. And I could blend 2. I could have all 3, or I just could look for 2 now. So let's take a look at the rejection. So at a key level, if I see price is going up, having a candle with a strong wick and a long wick, that is simply a strong rejection, and it means that the level is respected already. So a lot of times this is your signal to just enter the trade, because now you have a long wick. It tells you that the key level is filled, the key level is already respected, and you can take an entry. My problem with this is that a lot of times when we have a long wick, it's still gonna, so let's say we have the wick like this. A lot of time price will still go a bit above into the wick and then continue lower. It's not gonna give you the best reward to risk. Now, another thing that I want to see inside of the key level is a sweep. So key level, what I want to see is a creation of a strong high or strong low. In this case, a strong high, which means that I want to see a fake out pattern inside the level. That tells me that sometime, a fake out needs to be also with a wick. And a wick, when I have price going up and then going lower and then going above the high with a wick and then reversing, this tells me that there is weakness inside the level and there is price respecting the level, and I can take trade based on this. So when I see a fake out, I mean price going above a specific high or even the highest high inside the key level and never closing above it. Something like this, then reversing, and I can take the continuation, or I can even take a risky entry at the fake out itself. And I do actually have a very specific strategy just using this based on sessions highs and lows. When I have price failing to displace above specific session high, we take a short immediately, because based on probability this could work and result in a lot of reward to risk. Now the third trigger is acceptance. Think about when price is, we have a key level here and it's a bit big, it's a big range, price is going up and we're still staying inside of the range or inside of the key level actually, but the key level is way too big. If the level is bearish and then price goes into it, reject, and if I could see the sweep, if I could see the rejection, now inside of the key level I can see price going up and then we have a rejection, but price is still inside. Acceptance means that we see this or both at the same time, and then we come out of the level. So now price went to the level and then it's coming out of the level with a strong structure. This means, there needs to be a closure below, and that means we might have a continuation most likely, and that is what acceptance is. It's basically price going into the key level and then closing out of it in the same direction. If this bearish, we want to see a closure below. If we have a bullish level, we want to see a closure above. And a lot of time this could be enough signal in order to look for continuation in the same direction of the key level. Now, one rule that is really important and it's going to make a difference for you, you want to match strength and weakness. So strength with weakness, think about it this way. If the approach was strong or impulsive, what you want to see is weakness inside the level. So when we have a strong impulsive, you want to look for either a rejection or a sweep, and then price going to go in that direction. If the approach was corrective or weak, and a lot of times, regarding the levels or the approaches that I said I don't want to see when price is moving very slowly into your key level, in that case, and even if you wanted to enter based on this, what you want to look for is a strength inside. So we want to see acceptance and then drop out of the key level. In that case, even when the price behavior is not that good, you could still look for an entry and take the risk if you have a clear acceptance and a drop. But then if price was coming aggressively and strongly and impulsively into your key level, you could just look for rejection or a sweep, and that's going to be enough entry for you. So you want to match the strength and weakness together. When you have strength approaching the key level, you want to have weakness inside the key level. So let's look at some examples here on the euro dollar chart, and these are some key levels that I'm marking here that I always take my trades based on, okay, and based on the edge model. But for this video, what I'm going to teach you is take a look at the triggers pattern that I taught you and apply them to these random key levels here. Now, because we're using 4 hour here, we're going to go to 15 minute to look for the confirmation. Now let's look at the 15 minute, and we're looking at 3 things here. Now you could have your own confirmation pattern, okay? But the 3 things that we discussed are sweep, acceptance, and then rejection with strong wicks and big wicks. Now let's take a look at this key level here. So this key level created on the 15 minute, we want to look for confirmation when price comes back to it. In this case, you want to at least blend 2 or have them as confluences and then use logic 2. Okay, so if you notice here, as price is coming back, and depending on how big the key level is, so if the key level is way too big, you could refine. So if I'm just using my method, I'll refine to this key level here, okay? But I want to teach you everything about it, okay? So for any key level, so let's say you're just looking at this big level. In this case, when the level is too big and then price is just coming to the beginning of it, you either need to have a stop loss below the level, or you could refine it, or you could wait for more than one confirmation. So instead of just waiting for one tab of trigger, you could blend 2 and then wait for more confirmation. If the level is small, then it becomes, you can take actually much more risky entries. In this case, this is the key level. I want to see what happens. So as price is coming lower, here only price have a small wick and then close higher. I'm not gonna say this is way too convincing to take a trade based on. Price goes lower. In this case, I might take a trade based on this, maybe. But for me, I would always wait for some refinement, and I'll take based on some key levels deep inside the key level, okay? On the lower time frame, based on the higher time frame. But in this case, we see that price put a wick, reject it, and then there is acceptance here. So you could have taken an entry based on this, but then because the key level is a bit big, or you could have it below and then getting stopped out. So let's say you get a stopped out here, okay? We have a strong wick and we have rejection. For me, honestly, I would put it below here, even if it's gonna result in lower reward to risk. Now, take a look at what happened after. We have a sweep and then price goes up, but it's still very weak. What happened after here is another sweep into the refinement, and then we have a rejection. A lot of times, so you can take here the entry based on 2 triggers. What we have here is a liquidity sweep, and we have a rejection candle. So what could happen here is have a stop loss below the level, okay, and then targeting whatever. Now, if you want to look for another confluence as well, what we have here is 3 things actually. So 3 things happening at the same time for this last one, and that's why this is the real one. This is the one that had no drawdown at all. What happened is a sweep or fake out pattern, no displacement, weakness, you can call it whatever, okay? but I'm just used to say fake out. So you have a fake out failing to close below, and then what happened after? So three things. First of all, sweep, and then strong rejection, and then finally acceptance, which is coming out of the key level aggressively. So this is three things happening at the same time. That's why this is the most valid entry that you can take. And take a look at after price keeps going higher. Now we have another key level here. Okay, so based on the 4 hour, this is the key level. You want to do the same. You want to look for the trigger. What is a trigger? Now take a look at here. Price goes into the key level. There is acceptance here. There is a bit of a strong projection, okay, but the level is still big. So what you can do is take an entry at the acceptance, because now you have two things, but no sweep. There was no fake out. So you're going to have the limit order now, regardless of the timing of the day here, because usually no one is going to trade at this time. Now let's take a look at what's going to happen after price is going in, very close to the key level. There is a sweep here, not inside the key level, but of another key level. Price goes up. In this one, probably still not entering. I want to see price goes a bit deeper, because we already have the first retest of the level here. So I want to have another retest that is below this level. So what happened here is, here we have price taking the low, also taking this low, and then we want to see what do we have. We have a fake out of this low, and we have rejection. So if you'll notice here, this is a strong rejection, and then price is going up. So we have two things now. Where's the third thing? Price accepting the price and then going higher. So here we have three things. We have acceptance, fake out, and then rejection, and also another rejection here. So this could be your entry, and then if you notice after that, price just goes up strongly. Now we have another key level which is created here. Price goes lower, and the retest now this is where price goes to the key level. In this case, because the level is way too big, and in this case we have no sweep or fake out, this could be considered as a fake out, but it's not actually. So what happened here, maybe on another time frame, you're going to see it as a fake out and then rejection, okay? But on the 15-minute, which is the time frame that we're using here, there was nothing. So you could consider this as a fake out. Price going lower, having some reaction around the key level, the beginning of it, closing up. And here at this candle, we have the acceptance. So even though there was no clear rejection, actually I can see that on another time frame this would be a fake out and this is a rejection. So we have acceptance here, and you can take an entry based on acceptance. Stop loss goes above, and if you notice, price going lower, and that is some good reward to risk. Now after that, if you notice, as price is going up, what happened is a sweep or fake out, and then another acceptance, which you can take another trade based on. Now take a look at here. Price was going up. That's a key level. Let's see what happened on the 15-minute. Is price, we have this low that has an imbalance below. What happened is, and this is a whole key level here in the 4 hour. What happened on the 15-minute is price going down, taking the level. Okay, even though the timing is not good, so probably not going to be taking this trade. But if you notice, price takes the low and then close higher. Do we have a strong rejection on the low? Yes. That means we have first trigger. Another trigger is also we have the fake out. So we do have fake out. And then after that, we have the acceptance, price closing aggressively above. This could be an entry. And if you notice after that, we have a strong move to the upside. So this is what price behavior is about. It's about looking at the key level. Okay, key level. And then noticing what happened as price is approaching the key level. And then noticing what happened inside the key level, and then taking the entry based on these two. First one, when it comes to approaching, it's about validating the level and just from the beginning knowing if the level is valid or not. And then when it comes to price inside the key level, it's about the trigger, it's about the entry, and it's about the confluences to see inside in order to know when to take the trade. So that's it for the video. Hopefully you enjoyed it and hopefully you learned something new. Make sure to hit the like button, subscribe to the channel, and then make sure to leave a comment as well and share the video with your friends, because these videos, even though I do put a lot of time into and make sure that I simplify the concepts, they still can reach everyone who needs them. So make sure to share the video with your friends And make sure to check out its school, my community, and where I share my trading strategy and then trade with my members. That's it, and I'll see you next one.